Interest Rate Futures Beginner's Guide. My friend Mikey, why don't you start out by telling us the different interest rate futures you know of, the ones you've traded, the ones you like, the ones you dislike, why you like them, anything really you have on interest rate futures up until this point. You've been trading for almost a full decade in the futures and options derivative space. What do you know about interest rate futures?
Well, let's start off why I dislike them.
Good.
And really, one of the biggest things for me, and one of the reasons why I never got into traditional, regularly sized, huge futures contracts, was because of the barrier to entry of learning the tick sizes and the notional values and all these different things for every single product and how it's different. So really, looking back and thinking back into my exposure to futures trading, it was almost always things like oil futures, which easily translates to equities in the sense that it's not $100 per point, it's $1,000 per point, versus learning this brand new thing. I need to look at it differently than something else. It was just a red flag for me, which is why when the small stakes came out and the small exchange came out, making everything universal, where, whatever you're looking at, point is a point, $100 is $100. You don't have to learn all these crazy things just to be able to trade it. So that's my introduction into why now I trade a lot more small exchange stuff versus anything that I've never traded interest rates for.
You raise a great point here. It's one of those kind of generational differences almost, whereas if you learned how to trade stocks, options, and futures in 2015, then you had to, if you wanted to get into interest rates, you had to learn about why they're priced in 30 seconds of a point. It's not 1/100th a penny, it's 1/32. And it's these different multipliers. Every tick is $31.25. Oh, but the 10-year actually, it's half of that. It's $15.62. Oh, and the 5-year actually is half of that. It's $7.81. Absolute madness, a huge barrier to entry. But if you're learning to trade stocks, futures, and options, everything, crypto and otherwise in 2021, thankfully, you almost miss those products completely for good reason. They're extremely complex. They have $100,000 base par amount. So they're huge products. And yeah, the tick values, all this stuff is very, very complex. Dollar value, basis points, really, really crazy stuff. But in 2021, thanks to small exchange futures, they're smaller, they make more sense, they tick in penny increments, and as we'll see here in a second, they're priced in yield, not in bond prices, which I would contend is simpler for people to understand. So hopefully it is one of those back in my day, it was really tough to do this thing. And now everybody that's learning about interest rate futures and other asset classes, it's oh yeah, thankfully, we don't have to deal with all the crap of back in, Mikey's early days of trading. So let's get into just the concept, and then we'll get to product design and what you can do with the futures here. Laying a little groundwork, interest rates are benchmarks for borrowing and lending. And that's why they're a huge, huge asset class, because they affect so much stuff. You might think on the face of it, interest rates, really? That's not an asset class that's sexy. It's not appealing to me. It's not in my everyday life. But I would contend, Mikey, and I'm interested to see what you think, interest rates are kind of drivers of equities in a lot of ways. They drive metals. They drive all these different asset classes. They might be one of the most essential asset classes to everything that you trade, not to mention all of your car loans, your student debt, your mortgages. All these different things are based around interest rates, right?
Yeah. And one of my biggest realizations a couple of years ago was just looking at mortgage rates and how they're in the 2s and 3s, but your student loan rate is in, the 7 handle. And it's oh, okay, how is this a thing? It just doesn't make any sense at all. But yeah, my biggest thing with interest rates and how I like to conceptually think about it is, especially if you're familiar with options trading, is basically you're trading the different spreads and what you think how these relationships will move between the 2-year, between the 10-year and the 30-year. It's very much like there's a lot of earnings trades coming out. We were just talking about this on the previous show, Options Trading Concepts Live, where you can go and like look at Walmart and you can inventory this long-term implied volatility number, and you can buy that, and you can sell the near-term higher implied volatility number because you're betting on the relationship to converge closer to a normalized number. It's the exact same thing that you're doing with interest rate futures, except you don't necessarily need to have an expiration date. You don't have to have these staggered expirations, dynamic delta. You can do this in a static delta way. And if you're familiar with these relationships and you build the knowledge of these relationships over time, it can be a really nice trade.
Yeah, so many great points there. I love the analogy to volatility because it is what's really cool about this is that interest rates it's the same concept. All right. The only thing that's changing is the duration. Mm-hmm. And so, when you think about in volatility where it's like, oh, earnings are this month. So this expiration is going to have a higher volatility than next month because there's no earnings. Like earnings is going to affect the stock price less for the next 2 months than it will for just the next month. Same with interest rates where it's like, oh, in the next couple years, we're only going to have an interest rate of 0.5%. That's where it currently is. And by the way, these are Treasury yields, U.S. Treasury yields, which are the benchmarks for interest rates in our entire country and kind of the benchmarks universally as well. And so in the next 2 years, Mikey, it is kind of like, oh, it's at 0.5 percentage point. It doesn't fluctuate as much as the 10-year or 30-year because there's fewer unknowns. It's going to move around less. But when you get to 10 years of duration or 30 years of duration, it's a higher rate. They demand more interest be paid on anything that is being borrowed or lent for more time. And it's going to move around more. There's more. There's just more unknowns. There's more volatility as you add duration. But it's the same concept, just different durations, similar to implied volatility across different durations there in a stock or in any different market. And here you have just the most bare bones interest rate markets, which is, like I say, U.S. Treasury yields. And the most essential parts are the 2-year, which is really our short-term benchmark, the 10-year, which is our medium-term benchmark, and the 30-year, which is the long-term. And this is a very traditional curve that we have right now, which is the 2-year is lower than the 10-year, and the 10-year is lower than the 30-year. And that's because they demand usually more interest be paid for more duration in what's being borrowed or lent. But you do get these inversions, right? And that's what people talk about. Oh, is the yield curve inversion is a predictor of, economic strife. And those are weird times that we only see, a handful of days every year, a couple of years. So am I making sense from a conceptual standpoint how this yield curve is structured and how these rates are right now?
Absolutely. And it just reminds me of like contango and backwardation, going back to volatility. Mm-hmm. Like you said, these weird times where something crazy happens, that's when you see volatility futures go into backwardation, where the near-term number is higher than the back month number. So very similar layout here, just a different naming convention.
Absolutely. Absolutely. And so this is what the yield curve looks like right now. 2 years right now at 0.5%, was actually down at 0 since the start of the pandemic. And that's, this is just a beginner's guide, so I don't want to go too deep, but that's, a function of when the stock market fell and the pandemic was kicking into high gear, the Fed brought Fed funds rates down to 0%. And so the 2-year comes down close to 0%. And 10s and 30s fell as well, but not by as much, or else we would have gotten a yield curve inversion. But now sitting at 0.5%, it's been on the rise as the stock market has recovered, and just economic data has been looking good for the economy. Those yields tend to rise, and we'll get to that correlation with stocks in a second here. But very traditional curve. But what's also interesting, Mikey, and this is where we start to get to more the practical standpoint, is these yields move on a daily basis. They move on a second by second basis. I mean, I used to trade these interest rate products, the big ones that we alluded to at the start of the segment. I used to trade them during Asia and Europe. So even U.S. Treasury interest rates are moving like crazy during other continents' market hours. And so very, very just ubiquitous marketplace that is moving constantly. And you can see here the different lines that they move, back and forth. It's not a 1-for-1. They all move higher, they all move lower. You can see that 2-year has come off of 0 and rallied really high. That's that red line there. The 10-year, the middle term interest rate, it rallied to start 2021 and came back a little bit, and it's been moving kind of back and forth. The 30-year rallied as well to start the year, but has actually been on a little bit of a downtrend. And that's when we really start to get into the opportunities here, because this stuff moves based on sentiment in the market. If the traders are feeling good, positive, optimistic sentiment, yields are mostly moving higher. Vice versa for negative sentiment, and also data releases like non-farm payrolls and the Fed, the FOMC meetings that they have 10 times a year, and you're starting to see these are volatile markets that have opportunity on a day-to-day fashion, right?
Yeah. And you can see, right here, even though it looks like it's not a big move from 1.0 to, 1.6, it's still a large monetary move, regardless of what product you're trading.
Absolutely. I mean, look at this left rail here, the red y-axis. I know it's a little hard to read, but that's the 2-year. The 2-year interest rate has tripled this year. Mm-hmm. Like that's a 300% move in that product. That's really interesting stuff to start looking at. And it's all priced in yield. So if you're reading about yield on any media outlet, this is what they're usually quoting the 10-year, which is kind of the most popular benchmark. And what we're going to stick to a little bit here today as the conversation deepens. But it's quoted in so much financial news, and people are constantly talking about, what does that mean for interest rates or yields or what have you? This S10Y, the 10-year U.S. Treasury yield, is that benchmark that's always referenced. And you have in S10Y a product to trade. And you see here, Mikey, that it's got a real high positive correlation to the stock market. And that's because, when stocks are getting hit, they're falling, and the market is volatility is rising, fear is rising. Interest rates tend to move lower, both because people are buying bonds. And when you buy a bond, the interest rate, the yield on that bond moves lower tick for tick. So every tick higher in the bond, the yield moves lower a tick there. But also those yields move lower because in economic strife, people project that the Fed will lower rates as well. And so you have this two-headed monster kind of moving interest rates lower. When stocks are performing well, everything seems good. Yields are moving higher because there's the idea that, they're going to tighten rates to, combat these rising asset prices and everything else to make bonds seem more attractive. They're going to raise these interest rates. They're going to raise these yields. You can trade both sides of it here. It's actually been a better two-sided trade than stocks. Yeah,
I don't doubt that for a second.
And so you see here, a stock market that's kind of grinded higher. This is the SM75 there in red is the small stock market, which has your financials, your tech, and your energy and everything else. But yeah, you see this nice two-sidedness, and that actually creates a nice opportunity. One of the most classic trades is stocks against bonds, and we've done it a lot in the past, is when one is leading, the other is lagging, you kind of get on the other side of those, and vice versa, when the other is outperforming and the other is underperforming. But I mean, at the end of the day, Mikey, a real good place to start with interest rate futures, how to trade them, and what, just getting your hands a little bit dirtier in the space. Start with that 10-year rate, which is the most often quoted benchmark, and just where you think, given what you've read or what you see in the price action of, the stock market or of gold, which it also, there's usually a negative correlation between yields and gold and precious metals. When interest rates move higher, gold, which doesn't pay any interest, is tend to be thought of as less valuable. So those gold prices tend to move lower. So do whatever research you kind of do for any market and just try out a long or short position in this small 10-year yield. It's priced in yield, no crazy ticks. and the margin on it's just around $300. It's a product that's not very large. It's a very easy place to, like I say, get your hands a little bit more dirty. Did you start in the 10-year?
I can't say that I did because I barely started at all, but I will after this segment. I think the biggest thing with the 10 years, like we just talked about, it does move. It has a higher correlation with SM75 than the others. So it's easier to comprehend when you see the stock market going down, we see the stock market going up. If you can wrap your mind around what the 10-year might be doing, and then you can dig into pairs trading against the 2-year, 30-year. I like the idea of starting here.
Yeah, absolutely right. It's a great place to start and kind of think of it in the same vein as that stock market. It's like, oh, I think things will be good. And I think the Fed will hike. And I think, X, Y, and Z positive sentiment, then I'll buy an S10Y. Or, oh, I think that, there might be some strife here in the next couple of months or whatever. I'll sell an S10Y. And like I say, it's a small trade. It's easy to understand. If you buy it, you want rates to go higher. You sell it, you want them to go lower. And the tick increment is a penny that's equates to $1, just like 100 shares of an ETF or stock. So yeah, we're getting started here in interest rate futures. Hopefully everybody enjoyed that beginner's guide. And Mikey, I hope you enjoyed your time here on Small Stakes on Monday afternoon, because we absolutely love having you on, beanie or not. Did you have fun today?
I did. Learned a couple things. But yeah, I think getting started, especially with the small exchange side where you don't have to, again, like that was my biggest barrier to entry. I'm a very I want to be able to do something that gives me 95% of the results with, 5% of additional effort that I need to put into it. And the small exchange definitely helps you do that when it comes to understanding how these things move, universal tick sizes across the board. So yeah, I love it. And especially now, I think we're in a weird period where we kind of keep selling off the market highs. Like you said, we've had that 0% interest rate. They've increased it since then. So where do we go from here? I think it's hard to say, but there's definitely opportunities wherever you want to focus on in the market.
Awesome. Absolutely right. So many good, perfect way to end the show there. A lot of great points. And I really love your idea. And I guess we'll end on this. Like, whenever picking up something new, a really good company or a really good entity or a good product is kind of 95% intuitive and 5%, like there's always going to be that extra effort, right? Like nothing is 100% easy. It's like, oh, I'm trading interest rates for the first time. I'm going to need to put forth some effort to understand that. But hopefully the small exchange, like you say, can do that 95%. And then my own 5% gets us across the finish line and we're trading interest rates, baby. So yeah, we'll check back in on interest rates in the future. Like I say, 10-year S10Y, a great place to start. And it's a product that moves like $30, $40, $50 a day. And so if you just buy it or sell it and just watch it move for a couple of minutes, you'll be up or down, a couple of dollars unless there's some big outlier move. So always advocate for, and it's a tasty trade way. Is like the best way to learn things is the practical applied way to do things. So we'll see how those S10Y trades go next Monday and beyond, Mikey. But it is 12:30, and that means it's time for Splash into Futures. Thanks as always, Mike Butler, for joining us. Make sure to check out his show that's on it's 11 a.m. Central Time, right? Every day.
That's right. We hop on YouTube. We field questions live. So if you've got questions about small exchange stuff, we're trading that, options, equities, you name it. So yeah, 11 a.m. Central every day.
Awesome. Don't want to miss that. And Mikey, thanks as always. We'll see you next Monday. But everybody, hang tight. Splash into Futures coming up next. Thanks for watching, everybody. Peace.